What happened to silver when the price fell from $121 down to $64 was not what most people think, and it was definitely not the story that the headlines were pushing day after day while fear spread across the market. It was not the end of the silver bull market. It was not a bubble suddenly popping, and it was not proof that silver had become too expensive or worthless overnight, even though that is exactly how it felt watching red numbers stack up on screens. Many people believed the crash meant silver was finished because that is what the news repeated, and that is what emotions tend to say when prices fall fast and portfolios start bleeding for days in a row. But after digging deep into data that most everyday investors never even think to look at, the picture that emerged was very different, and honestly, it completely changed how this entire move makes sense. The silver crash was not driven by people who truly understand silver deciding to walk away from it, but instead by people who were gambling on silver using borrowed money and were forced to sell whether they wanted to or not. Once you understand that difference, the entire move starts to look less like failure and more like a mechanical event that had nothing to do with silver's real value. At Alex Carter Reports, this is exactly the type of hidden information we focus on, because the real story is almost always buried under fear, noise, and oversimplified headlines. The crash was not emotional, it was mathematical, and it followed rules that most retail investors never learn about until after they get hurt by them. To understand this properly, you first need to understand how the silver futures market actually works, especially in the United States, because this is where much of the chaos begins. On the COMEX exchange, which is the main silver futures market in the US, traders are allowed to control massive silver positions using only a tiny amount of their own money. In many cases, a trader can control a full silver position by putting up just 5% of the value themselves, while borrowing the other 95%. That means for every dollar they actually own, they're controlling about $19 worth of silver, which is an extreme level of leverage that magnifies both gains and losses. To put this into simple terms, imagine you have $1,000 of your own money, and through leverage you are suddenly controlling $19,000 worth of silver instead. If silver rises just 5%, your $1,000 turns into $2,000 very quickly, which feels exciting and powerful, and this is exactly what draws so many speculators into the market. But the danger sits on the other side of that trade, because if silver falls by just 5%, that entire $1,000 is gone instantly. There is no waiting, no patience, and no chance to recover calmly because the system does not allow it. When losses reach a certain point, the exchange steps in and forces the trader to close the position immediately through what is called a margin call. A margin call is not a suggestion, it is a command, and traders do not get to argue or delay once it happens. Now imagine thousands of traders all using heavy leverage at the same time, all watching the price dip just enough to trigger these forced exits. As they are forced to sell, their selling pressure pushes the price even lower, which then triggers margin calls for the next group of traders. This creates a chain reaction where selling causes more selling, and the price falls not because of fundamentals, but because the system demands liquidation. This type of move feeds on itself and becomes violent very quickly. Even though nothing about silver's real supply or demand has changed at all, that is exactly what happened during the drop from $121 to $64. And the speed of it is what made it feel so shocking and final to many people. The process did not stop with one round of pressure, because margin requirements kept increasing as volatility rose, which added fuel to the fire. Margins first moved from 5% to 8%, and that alone was enough to wipe out the most aggressive traders almost instantly. Then margins were raised again to 11%, forcing another wave of liquidations from traders who thought they had more breathing room. After that, margins jumped to 15% and then to 18%, pushing out nearly everyone who had relied too heavily on borrowed money. Each increase created a new wave of forced selling, and each wave pushed prices lower, which made the next margin call even worse than the last. This was not investors calmly deciding silver was no longer worth owning. It was traders being shoved out of positions they no longer had permission to hold. A good way to understand this is to imagine a crowded movie theater where someone suddenly yells fire, even if the building itself is still perfectly fine. People rush for the exits, not because the movie suddenly became bad, but because everyone else is running and the doors are narrow. The chaos makes it look like the whole building is collapsing, even though nothing about the structure has actually changed. Silver went through that same type of stampede, where fear and forced movement created destruction that looked far worse than reality. The fundamentals of silver, meaning real supply and real demand, did not suddenly disappear during this crash. The physical silver market did not collapse, and the need for silver in industry, energy, and manufacturing did not slow down. What collapsed was leverage, and when leverage collapses, it always looks like the asset itself is broken. At Alex Carter Reports, this distinction matters more than anything because it separates long-term reality from short-term chaos. Once the forced selling finished and the weakest positions were wiped out, the market was left with participants who could actually handle volatility. These remaining holders are not the kind of traders who panic at every small dip, because they are backed by real capital and real conviction. This kind of reset often leaves a market cleaner and stronger, even if the price action makes it feel terrifying in the moment. The silver crash was not the end of the story. It was the clearing of excess risk that had built up too fast and too aggressively. When you understand that, the fear-driven narrative starts to fall apart, and a very different picture begins to form. And this is only the beginning of the data, because once we move past leverage and forced selling, the physical silver market tells a story that is even more surprising. If this perspective already feels different from what you've heard before, that's because most outlets never explain what happens behind the scenes. At Alex Carter Reports, the goal is not to chase price moves, but to understand what is actually driving them beneath the surface. The crash from $121 to $64 was loud, dramatic, and emotional, but the real signal was hidden underneath the noise. And once you see what the physical market was doing during this chaos, it becomes impossible to look at this move the same way again. Once the forced selling settled and the dust started to clear, the next step was to look for proof, because opinions do not matter in markets, only data does, and this is where the real story becomes impossible to ignore. Instead of guessing who sold and why, the cleanest way to understand what happened is by looking at something called open interest in the silver futures market. Open interest simply tells us how many futures contracts are still active, meaning how many traders are still holding positions at any given time. When silver was racing higher toward its peak, near $121, open interest climbed sharply and eventually reached about 176,000 contracts, which shows how crowded the trade had become. That number represents the maximum level of speculation, where huge numbers of traders were all betting on higher prices at the same time. After the crash, when the price had already fallen hard, open interest dropped to roughly 137,000 contracts, which is a massive change in a very short period. That means about 39,000 futures contracts simply vanished during the decline, and positions like that do not disappear unless traders are forced out. These were not calm, long-term investors quietly taking profits. They were leveraged speculators who could not survive the margin calls. This is actually one of the most important bullish signals most people completely miss, because when weak hands are removed, the market becomes more stable. The traders who remain after this kind of purge are the ones who can afford volatility and are not likely to sell just because of a small price swing. In other words, the market just went through a deep cleaning, and clean markets tend to move with more strength once they find their footing. Another important detail is where many of these traders exited, because behavior around key price levels often reveals long-term psychology. A large number of traders closed their positions around the $50 level, which is not random at all when you look at silver's history. Silver topped near $50 back in 1980, and again around $50 in 2011, which made that price level feel like a ceiling for decades. When silver fell back through that level during the crash, many experienced traders saw it as a logical place to lock in profits and step aside. That does not mean they stopped believing in silver, it just means they respected a level that had mattered for 50 years. What matters now is what happens next. Because if silver holds above $50, $60, or even $70, those same traders have strong reasons to return. When an old ceiling turns into a new floor, it often attracts fresh buying interest from people who previously sold at resistance. That creates a large pool of potential demand waiting on the sidelines, not a lack of interest or belief in the market. This alone weakens the idea that the crash was bearish, but the story does not stop in the United States. To see if this was a global event or just a local one, the same data was pulled from China's silver futures market. The result was almost identical, with open interest surging during the rally and then collapsing sharply during the crash. This confirms the move was not caused by one exchange or one country, but by leveraged speculation being flushed out worldwide. Seeing the same pattern on two continents at the same time removes emotion from the analysis and replaces it with clarity. The gamblers were removed from the system, but the silver itself did not suddenly lose value or usefulness. Supply conditions did not improve, demand did not disappear, and industrial needs did not slow down. The only thing that changed was leverage, and once that leverage was gone, the price stopped falling in free fall. At this point, the next logical step was to stop looking at paper markets altogether and focus on the physical silver market instead. The physical market is where real metal changes hands, and it is driven by people who actually need silver, not traders chasing charts. This led straight to the London silver market, which is the largest hub in the world for trading physical silver. In London, silver is not just bought and sold, it is also loaned between participants who need metal for short periods of time. The cost of borrowing physical silver is measured through something called the lease rate, and this number reveals stress in the system. In a normal market, the 1-month silver lease rate stays near zero, moving slightly up or down depending on conditions. Anything above 1% already signals tightness, meaning silver is becoming harder to source. Right now, the 1-month silver lease rate is around 4.5%, which is an extreme level that almost never happens. Just 1 or 2 years ago, throughout 2023 and 2024, lease rates were flat at zero, showing a calm and balanced market. A jump from 0 to 4.5% is not a warning sign, it is a full alarm signaling physical shortage. While futures prices were crashing and headlines were screaming that silver was finished, professionals in London were paying extreme rates just to borrow metal. This kind of disconnect between paper prices and physical demand is rare and deeply meaningful. One of these markets is telling the truth, and it is not the one driven by leveraged speculation. But the signals did not stop there, because another indicator revealed even more pressure under the surface. This indicator is known as the 1-year silver swap rate compared to U.S. interest rates, and it helps show urgency for physical delivery. In a healthy market, silver for delivery in the future usually costs more than silver delivered today. That extra cost reflects storage, insurance, and the time value of money, and it signals calm conditions. When this relationship flips, and silver today costs more than silver in the future, it signals desperation for immediate supply. This condition is called backwardation, and it is extremely unusual for a metal that can be stored like silver. Right now, silver is not just in backwardation, it is in the deepest backwardation seen in modern data. The 1-year silver swap minus U.S. interest rates sits around negative 3.5, a number that should normally be positive. This means buyers are willing to pay extra to get silver now instead of waiting, which shows urgency that cannot be faked. The physical market is not whispering here, it is shouting that silver is scarce. When you combine collapsing open interest, record lease rates, and extreme backwardation, the picture becomes clear. The crash was not about demand disappearing, it was about leverage being destroyed. And as this continues, the behavior of physical inventories adds another powerful layer to the story. Once the focus shifts fully to physical silver inventories, the story becomes even clearer because inventory levels do not lie and they cannot be explained away by emotion or headlines. Inventories show where metal is actually moving. And when silver leaves vaults, it means someone is buying it and taking it seriously. At Alex Carter reports, inventory data has been tracked closely across multiple exchanges, and the trend has been impossible to ignore. The COMEX silver inventory chart shows a steady step-down pattern, where each week less metal remains than the week before. Month after month, silver continues to leave the vaults, and there has been no sign of stabilization or reversal. The registered inventory, which represents silver available for immediate delivery, has dropped to its lowest level in months. Just 6 months ago, this number was roughly double what it is today, showing how quickly available supply has tightened. This is happening even after a price crash, which should not happen if demand has truly dried up. The Shanghai Silver Exchange tells the same story, but on an even larger scale. Inventory levels there have fallen from over 1.2 million down to around 350,000 in a relatively short time. This is not slow leakage, this is aggressive and sustained withdrawal of metal from storage. Earlier data showed Shanghai vaults draining at a rate of about 42 tons per week, and that pace has not slowed. If anything, it appears to have increased as buyers take advantage of lower prices. This raises an obvious question that most headlines never ask. If silver truly became less valuable during the crash, why is physical metal still leaving vaults faster than before? If demand had collapsed, inventories should be rising, not falling. If no one wanted silver anymore, lease rates would be dropping instead of reaching extreme highs. If the bull market were truly over, backwardation would not be deepening at historic levels. The answer is simple and uncomfortable for the mainstream narrative. The crash had nothing to do with demand and everything to do with leverage. To understand this fully, it helps to walk through the sequence of events step by step without emotion or bias. First, silver rallied strongly from $37 to $121 over several months, drawing massive attention from traders looking for quick gains. During that rise, leveraged speculators piled into futures contracts, often risking very little of their own money. Hope and interest surged to 176,000 contracts as this behavior intensified. Next, as the price moved faster and volatility increased, exchanges raised margin requirements to reduce systemic risk. Margins moved from 5% to 8%, then to 11%, then to 15%, and finally to 18%. Each increase forced traders to either add more capital or exit their positions. Many could not add more capital, so they sold, pushing prices lower. Those lower prices triggered margin calls for other traders, and the cycle repeated. Within days, silver collapsed from $121 to $64, wiping out about 39,000 futures contracts. These traders were not wrong about silver long term, they were simply over-leveraged. Once the liquidation was complete, the market was left with participants who had real capital and real reasons to hold silver. This is where the current phase begins, and it is very different from what the price alone suggests. Right now, speculative pressure is low, leverage has been flushed out, and open interest sits near multi-month lows. At the same time, physical demand is stronger than it was before the crash. This creates a powerful imbalance where price has fallen but scarcity has increased. That imbalance acts like a coiled spring, storing energy rather than releasing it. The harder prices push down while demand remains strong, the more violent the eventual release can be. This is something stock market investors often struggle to understand about commodities. In stocks, falling prices usually scare buyers away. In commodities, falling prices often attract buyers who need the product regardless of price action. A solar panel manufacturer does not stop buying silver because a chart looks bad. A mint does not cancel orders because futures traders got liquidated. They see lower prices as an opportunity to secure supply more cheaply, not as a warning sign. That behavior explains why inventories kept falling even as the price collapsed. Physical buyers treated the crash as a sale, not a signal to run away. Now it is important to address the emotional side of this move because different viewers experience this crash very differently. If you sold during the crash, that reaction is understandable because fast declines create panic even in experienced investors. But the data raises an important question worth asking honestly. Does a market showing extreme physical tightness really look like a market that has finished rising? Or does it look like a market where paper prices temporarily disconnected from reality? If you held through the crash, the data suggests the underlying structure never broke. Inventories continued to decline, lease rates kept rising, and backwardation deepened further. The foundation of a bull market is not the price on a screen, but the balance between supply and demand underneath it. That foundation has actually grown stronger since the crash. For those watching from the sidelines, this data provides context that headlines never offer. The traders who caused the crash are gone, and the leverage that amplified the move has been removed. The physical market, however, is tighter than at any point earlier in this cycle. Based on current data, the area around $70 has a strong chance of becoming a new structural floor for silver. The reason is simple, because the force that drove prices down has already burned itself out. There are not enough leveraged speculators left to trigger another cascade of forced selling. Meanwhile, the forces that push prices higher remain firmly in place and unchanged. Supply is tight, demand is strong, and inventories continue to fall. This does not guarantee immediate upside, but it does reshape the risk profile dramatically. Silver mining stocks add another layer to this picture that is worth paying attention to. Many miners are still priced as if the crash proved the bull market is over. Their valuations reflect fear, not current physical reality. If silver holds higher floors and physical tightness persists, these stocks may need to reprice quickly. This is not optimism. It is simple math, catching up to conditions on the ground. As all these signals come together, it becomes clear that the crash was not a breakdown. It was a reset that removed excess speculation and left the real market exposed. And when the real market tightens while prices stay low, the next move tends to surprise people. When all of these signals are viewed together, it becomes clear that this silver story is not just about charts or short-term price moves, but about deeper forces that are slowly reshaping the entire market. There's also a bigger backdrop that many people overlook, which involves government policy and strategic decisions made by the world's largest economies. China and the United States have both taken unusual steps regarding silver in recent months, and these actions send a message that is easy to miss if you only watch prices. China implemented export controls on January 1st, 2026, limiting silver exports to just 44 approved companies, and effectively keeping 60 to 70% of global refined silver supply within its borders. At nearly the same time, the United States added silver to its list of critical minerals in November 2025, which is not a label given lightly. Governments do not classify a material as critical unless it is both essential and increasingly scarce. These moves suggest silver is being viewed not just as a commodity, but as a strategic resource tied to energy, technology, and national security. What makes this even more important is that inventories in both the US and China are falling at the same time. This is not something that happens often, and it strongly suggests coordinated demand rather than random market behavior. When the largest producers and consumers of a material start treating it as strategic, it changes the long-term picture completely. However, it is important to be honest about risk, because no market moves in a straight line forever. There are clear signals that would challenge this view if they appear, and those signals are being watched closely. If lease rates in London fall back towards zero, that would indicate physical tightness is easing. If backwardation fades and the market returns to normal pricing structures, urgency for immediate supply would be declining. If inventories at COMEX and Shanghai start rising consistently, that would signal new supply entering the system. Over time, higher prices could also push industries to find substitutes or become more efficient with silver usage. Increased copper production could bring more silver to market as a byproduct, which would help balance supply. None of these risks are being ignored, and they are tracked week by week as conditions evolve. As of today, none of these warning signs are present in the data. Lease rates remain elevated, backwardation remains deep, and inventories continue to decline. The core message is simple but powerful. The data did not change during the crash, only the price did, and the price changed because leverage collapsed, not because silver lost its value or usefulness. There's also something important happening in silver mining stocks that deserves attention. Many mining stocks are still trading as if silver at $50 is the best case scenario, and any rally beyond that is temporary. This pricing assumes the old reality where $50 was a ceiling, not a floor. If silver stabilizes above $70 and physical tightness remains, those assumptions may prove incorrect. When markets realize the floor has moved higher, revaluation can happen quickly and sharply. This kind of repricing is often sudden because it is driven by recognition rather than speculation. Bringing everything together, this crash fits into a much larger story that has been building over time. Earlier analysis showed silver vaults draining simultaneously in Shanghai, New York, and London for the first time in modern history. Previous patterns also showed multi-month surge cycles that historically led to large percentage gains. This crash did not break those patterns. It reinforced them by removing excess leverage. The paper price fell, but the physical market tightened further. Speculators exited, but long-term holders remained. Inventories declined, lease rates rose, and backwardation deepened. Everything that matters for the long-term case strengthened during the crash. The only thing that weakened was confidence among those who do not track this data. Years from now, this period may be studied as a textbook example of how futures markets can temporarily detach from physical reality. Analysts will point to lease rates, inventory declines, and backwardation as early signals that were visible in real time. The crash will be seen not as an ending, but as a reset before the next phase. At Alex Carter Reports, this data will continue to be tracked closely as the situation develops. Every lease rate update, inventory report, and structural shift will be analyzed with context, not emotion. If this breakdown changed how you see the silver crash, share it with someone who panicked and sold. They deserve to see the full picture before making their next decision. The crash was not the end of the story. It was the reset before the next chapter. The leverage is gone, the metal is still leaving vaults, and physical demand remains intense. The real question is not whether silver recovers, but whether you're positioned when reality reconnects with price. This is the Alex Charter Reporter, and the signals are there for anyone willing to look beyond the headlines.